Hey guys, welcome back to Module 4, Analyzing and Interpreting Financial Statements. Up to this point, we really focus on how financial statements are constructed and how transactions affect them, but this module sort of begins a shift. Now we're asking, what do the numbers actually tell us about the business? So for MBA students, this is one of the most important chapters in the financial accounting portion of the course because financial statement analysis is ultimately about evaluating performance, efficiency, risk, and decision making. So the key idea I want you to remember is a ratio is not the conclusion, a ratio is the beginning of the analysis. Once we calculate a number, the next question is always, why does it look this way and what does it tell us about the business? So the return on equity. ROE. It measures return from the perspective of the company's stockholders, and conceptually it asks how much profit did the company generate relative to the shareholders' investment. Suppose two companies both earn about $20 million in net income. If one required $100 million of equity and the other about $400 million, their performance is not the same. That's why we use return measures rather than simply comparing absolute profit. But we know ROE by itself is not enough. We also want to understand what is driving it. This is where DuPont analysis becomes useful. At a high level, ROE can be broken into factors related to profitability, asset productivity, and financial leverage. Really where the book will talk about, it shows the return on assets can be decomposed into profit margin times your asset turnover. That gives us two different ways a company can generate strong returns. A company can generate a high margin on each dollar of sales, or it can generate a high volume of sales relative to the assets invested in the business. Some companies do well because they charge premium prices and earn strong margins, while others operate on thinner margins but use assets extremely efficiently. Neither model is automatically better. The appropriate model depends on the company's industry and strategy. Then looking at profitability, one useful measure for profitability is gross profit margin. Gross profit margin is revenue minus cost of goods sold, and gross profit margin helps us understand how much of each sales dollar remains after the direct cost of the product. So if the gross margin declines, a manager should not simply say gross margin went down. The real question will be why. Possible explanations could be lower selling prices, higher production or purchase cost, increased competition, changes in product mix, lower volume, higher warranty or supply chain cost. But that's the difference between calculating a ratio and analyzing one. The other side of ROA is return on assets is asset turnover. Asset turnover asks how effectively the company is using its assets to generate sales. A company can improve returns by increasing sales without requiring a proportional increase in assets. Or it can reduce unnecessary assets while maintaining sales. That's a very managerial way to think about productivity. For example, if a company can reduce excess inventory without hurting sales, it may free up cash and improve asset utilization at the same time. Working capital and the cash conversion cycle. The chapter then looks at drilling into specific operating assets and liabilities, especially accounts receivable, inventory, and accounts payable. Those will feed into the cash conversion cycle. Conceptually, the cash conversion cycle asks, how long is cash tied up in the operating process? We can think about three different components here. Days inventory outstanding, which is how long the inventory sits before being sold. Days sales outstanding is how long customers take to pay. And days payable outstanding is how long the company takes to pay its suppliers. So generally, a shorter cash conversion cycle means cash is moving through the business more efficiently. But again, context matters. A very low or even negative cash conversion cycle can be a strength if the company collects from customers before paying suppliers. Apple is a great example of this, being a strength. So its business model allows it to operate with a negative cash conversion cycle, meaning it can receive cash from customers before the supplier payments are due. So it's not automatically a sign of financial weakness, but it can reflect a very powerful operating model. So looking at this from a manager's lens, is a lower cash conversion cycle always better? Suppose a company reduces its cash conversion cycle from 80 days to 50 days. That sounds positive, but we still need to ask how it happened. Did management improve the inventory turnover? Did customers begin paying faster? Or did the company simply delay paying suppliers? Those are all very different explanations. If the improvement came entirely from stretching supplier payments, the company may be damaging important supplier relationships. So again, the number gives us the signal. The manager still needs to understand the cause. When we talk about financial leverage, it measures the extent to which a company finances its assets with debt rather than equity. Debt can improve returns to shareholders when borrowed funds are invested in activities that generate a return greater than the borrowing cost. But leverage also increases risk because debt creates contractual obligations. Interest must be paid, principal eventually must be repaid. So if ROE increases significantly, don't automatically conclude that operating performance is improved. You need to ask, did profitability improve? Did asset productivity improve? Or did the company simply take on more debt? Because that distinction really matters. When ROE can sometimes be misleading when stockholders' equity is very small or even negative. And the reason is because equity is in the denominator. So a small denominator can create a very large return on equity. It's leverage. While even if the company's underlying performance is not extraordinary. This happens in companies that have repurchased large amounts of stock or have low retained earnings. When this happens, analysts place more emphasis on measures such as return on assets or operating performance rather than interpreting ROE in isolation. So that's another example of no single ratio should dominate your analysis. When we look at operating versus non-operating performance, the basic idea is that companies primarily create value through their core operations. So analysts may want to distinguish operating assets and liabilities from financing related items. And it leads us to measures such as net operating assets, NOA, or net operating profit after tax, NOPAT, and return on net operating assets, RNOA. And I do not want you to get lost in the terminology here, but the main question is how much return is the company generating from its actual operating business? That can give us a clearer view of performance rather than mixing operating activity with financing effects. Looking at it again from a manager's perspective, you may have strong ROE, but you got to ask why. So imagine a company reports ROE of 30%, sounds impressive, but before you can conclude that the management is doing an excellent job, you need to ask, what is the company's ROA, return on assets? How much debt is it using? Are the profit margins strong? Is asset turnover improving? Is the return coming from core operations or from financial leverage? A strong manager does not stop at return on equity as 30%. A strong manager asks, what created the 30%? what I want you to know from the module is first, you need to understand what ROE measures and why return measures are more useful than simply comparing dollar amounts of income. Second, I need you to understand the logic of DuPont analysis. ROE is driven by profitability, productivity, and financing. Third, you need to understand the difference between profit margin and asset turnover. One measures the profitability per dollar of sales, and the other measures how efficiently assets generate sales. Fourth, you need to understand the cash conversion cycle and how inventory, receivables, and payables affect operating efficiency and cash. Fifth thing, you need to understand the role of financial leverage. Debt can increase shareholder returns, but it also increases risk. And finally, remember this: never stop at the ratio. Always ask, why did it change? How does it compare with competitors? Is the change sustainable? And what does it tell us about management's decisions? That's really the core of financial statement analysis. In Module 5, we're going to take that same analytical mindset and apply it to more specifically to revenue, receivables, and operating expenses.